Container rates hit record highs in a sign that freight inflation is soaring amid the crisis in the Red Sea and continuing risks of attacks by Yemen's Houthis. So here's the situation. Last week, rates were around $1,900 for a 20-foot container from Shanghai to the UK to $2,400 for a 40-foot container. On Thursday only, and in a matter of a few hours, the price shot up to $10,000 per 40-foot container. IKEA is one of the companies that indicated that the trade diversions will impact product availability. As you can see from the map, in an hypothetical route from southern China to London or even eastern US, the transit time through the Cape of Good Hope in South Africa would be longer by at least 15 days, adding to fuel costs, staff costs, but also insurance costs when compared to a transit via the Suez Canal in Egypt. This will add to threats to the global supply chain after 3 years of inflationary pressures and delays from COVID disruptions, which recently seemed to finally have subsided. For more on this now, let's go to Jamil Ahmed, who is chief analyst at online trading brokerage GTC. Thank you for being with us today. So several shipping companies have decided to suspend transits via the Red Sea. What's the economic impact of adding 14 or 15 days to the transit, including additional fuel costs?
Thank you, Ludovica. This situation just goes that you never say never to anything in international finance and also international economics, because this certain situation is brewing and escalating at a time where many financial markets are beginning to close, traders are away from their desk, same with supply chains and so forth. Generally speaking, the concern right now is whether this will continue to escalate or whether it will be a short-term thing. And that will then decipher whether this becomes more of a risk for 2024 and maybe something that makes traders and economists and so forth continue to remain at their desk over the Christmas period. Generally speaking, yes, there is a little bit of a market reaction. You've mentioned very well there what's happening with the container shipment prices and so forth, and maybe supply chains. What we're also looking out for is some sort of a recovery in the oil price, because we're seeing some moderate price increases with price action, but the oil price hasn't moved that significantly so far. That does make it suggest that perhaps this won't be such a long-term move. But again, this is a volatile situation, it's sensitive, and we just have to take everything step by step.
And there's already a vast military presence in the area, increasing now. I mean, is it sufficient to deter the threat? Also bearing in mind that some of these attacks are carried out with relatively low cost, such as small drones.
Again, this situation, whether this becomes more serious over the coming days or hours and so forth, or whether it becomes something quite similar to the very unfortunate situation that's already taken place in the Middle East, that time remains to be seen there. Generally speaking, we do not see that much geopolitical risk premium being priced into international financial markets, international asset classes, and so forth. Yes, we're seeing some reaction, but is it that much more material over the longer term if we start looking at bigger asset classes? Not really. Nonetheless, because inflation and price pressures are such a concern and supply chain issues following COVID, as you rightly pointed out, this is still something to monitor, and we need to now see whether we need to monitor this as a key market event risk or market risk moving forward, or whether this might just be, I won't say a storm in a teacup kind of a pun or analogy, but we have to see how much of a long-standing thing this is for international economics.
Jamil Ahmed, thank you very much for your analysis.